The next thing we are going to talk about is angel investors. So who are these angel investors? See, an angel investor is an affluent individual who provides capital for a business startup, usually in exchange for convertible debt or ownership equity. So, he is financing for the project, right, for the startup, okay. He either takes that money as a debt or he may take that money also in the form of shareholding, okay. See, generally, angel investors invest in the small startups or the entrepreneurs. See, the angel investors majorly will be their family members or the friends, because this is a startup, right? Who will come and finance me? Obviously my family or my friends, right? So the angel investors are also the investors who invest the money in the startups. Primarily, they will be what? They will be family or friends. Now coming to mutual funds. See, I'm just telling you just the meanings of all the terms associated with it. Okay. Now coming to mutual funds. So what does a mutual fund mean? See, if you are buying a single share, okay, sometimes it may increase, sometimes it may decrease, right? What will happen in the mutual fund? You will buy shares of company A, shares of company B, and shares of company C. Like that, you will be grouping the shares of different companies. So, whenever there is a price volatility of A, the price of B and C would help you in maintaining the money which you have invested. So, mutual funds is nothing but grouping of shares, and then you're buying a group of shares from different companies, not from a single company. Okay, you have to know this mutual funds, what is it? Now, next is non-banking financial company. What is it? A non-banking financial company, which is called as NBFCs, is a company registered under the Companies Act of 1956. Okay, what does it do? See, it will engage in giving the loans and the advances. Okay, same way as a bank do. Banks also gives loans and advances, right? So it will also engage in giving loans and advances and the acquisition of shares, stocks, bonds, debentures, securities issued by the government or other marketable securities of leasing, hire purchase, insurance business, chit business. Okay, basically it is also like a bank which is involved in giving the loan and getting back the money, but it does not include any loan. It does not give any loan to any institution which involves agriculture activity, industrial activity, purchase or sale of any goods other than the securities, or providing any services and sale, purchase and construction of immovable property. Two things you have to remember: it will not allow anything for agriculture and it will not allow anything for immovable property. These are the main difference you have to notice about NBFCs. Alright, now, so I told you they are also involved in leasing, hire and purchase, right? These things also you have to remember. Now, what is the difference? Like banks, it is also lending. So, what is the difference between the banks and the NBFCs? See, NBFCs cannot accept demand deposits. This question is often coming in the question papers. So, you have to remember NBFCs will not accept demand deposits. Okay, and NBFCs do not form the part of payment and settlement system and cannot issue checks drawn on itself. So it cannot issue checks. It cannot accept demand deposits. It is not the part of payment and settlement system. See, deposit insurance facility of Deposit Insurance and Credit Guarantee Corporation is not available to the depositors of NBFCs, unlike in the case of banks. You should understand that in the case of banks, if you are making a deposit, you have an insurance for it because the banks have to repay it to you. But in the case of NBFCs, if you're paying the deposits, if you're putting deposits in it, you don't have the deposit insurance scheme, right? Now, see, there are NBFCs, different categories of companies in the NBFCs, okay? Majorly the venture capital fund, merchant banking companies, stock broking companies are controlled by SEBI. Okay, see, in this what you have to remember is how is chit funds controlled? This was a question once. So how is chit funds controlled? Chit funds are controlled by respective state governments. You have to remember this. How is this chit funds controlled? They are controlled by respective state governments. Okay, I'm repeating it because this is asked in the exams. Now, coming to the next topic, which is called as derivative. What is a derivative? You could be seeing this in the newspapers. What is it? See, commodities whose value is derived from the price of some underlying asset like securities, commodities, bullion, currency, interest level, stock market index, or anything else is known as derivatives. Basically, you are deriving the price value of the commodity based upon some underlying asset. You have an asset. Based upon that asset, you are deriving the value of the commodity. We call this as derivative. Okay. What does derivative trading means? Basically, you are trading the derivatives. We call that as derivative tradings, right? Now, what is a forward contract? See, you have something called forward contracts commission as well. Okay, you have to look into that. So, what is a forward contract? See, let us take a person X and Y. Okay, X is saying that at Jan 1st, 2019, I will buy a product for 1 lakh rupees. But he is giving the assurity of this today. Okay, he is giving this assurity today. Then he is putting a contract with the seller. In a future date, he will buy it, but he is putting it today. And the price in which he is going to buy at the future date is also mentioned today. We call this as forward markets, right? Now, there is something called participatory notes. This is about the forward markets. The next term associated with it is participatory notes. What is it? See, the foreign investors, if wanted to invest in the investment market in India, they have to come through SEBI. Okay, but there is a mechanism which gives the flexibility to the foreign investors without much rules and regulations. That is the participatory notes. They allow the foreign investors to buy stocks listed on the Indian exchanges without being registered. So they don't have to register with the SEBI. So they can directly buy it and sell it, right? We call this as participatory notes. See, this has become popular because there is no need for registering it whom you are, right? There is no KYC problem associated with it, and you can maintain your anonymity. Okay, so that is the reason this participatory notes has gained its popularity. The next term associated with the capital market is insider trading. What is this? What is the insider? See, insider is a person who is internally connected to the company. By the name itself, you know that insider is a person who is connected to the company. Okay? He may be an employee, he may be a director, or he may be a director's friend or director's relative's friend, something like that, or he may be an ex-employee as well. Okay? But he is connected internally to the company who has access to the price sensitive information. Okay? If the company is going to sell the shares at this particular price, okay, this person will already know it. Okay? The insider trading regulations has been notified by SEBI in 1992. Okay? It prohibited the insider trading. Why? Because it is unfair upon the common investors. See, I may have a relative in a company, so I may get access to it and I may invest in it. But what if the person who is not having any information about the company, right, who is not having any relatives in the company, he will be suffering, right? So, insider trading regulations in 1992 notified by SEBI prohibited the insider trading. Person who possess price sensitive information because they have connections with the company take the advantage of the situation. We call this as an insider trading, right? So basically insider trading is unfair. So you will be getting in the newspapers, insider trading rules has been amended or some kind of current affairs related with insider trading. So you have to look into it. Now, the next term associated is G-Secs and T-bills. What are these G-Secs and T-bills? See, these are nothing but the government securities. Okay? The government of India, long-dated papers and the short-dated treasury bills. The long-dated papers in the sense, if it is for a longer period of time, then we call that as a long-dated paper and we call that as G-Secs. Okay? We call this as G-Secs. And the short-dated paper is called as treasury bills. Right? These are called as G-Secs and T-bills, or the two sets of securities by which the government of India borrows from the people. So generally they may be from 1 year to 20 years. Okay, G-Secs will be from 1 year to 20 years. See, the T-bills will be from 14 days to 364 days. Okay. See, these are called as gilt-edged securities because they are secure. You don't need to worry, right? It is a government security. So, for the government security, in the question papers, you may also come across the another term which is called as gilt-edged security. Okay? The next term associated with it is bull. So, what is a bull? See, a bull is an operator who expects a rise in the prices of securities in the future. Right now, the price of the security is not high, but he is expecting that the price of those securities will rise in future. So, he is buying all the securities right now and he will be selling those securities at the higher prices in future. Basically, he is having an optimistic approach, right? Next is bear. What is a bear? See, he is a speculator. What is a speculator basically? Speculator is a person who is involved in buying and selling of shares. So, bull is also a person and bear is also a person. Okay. He is also a person who is expecting that prices will fall in future. So, he is having a pessimistic approach. So, what will he do is, he will sell all the shares right now because now it is at a standard level of price, right? Now, it may be at any price, but he is selling the shares right now, securities right now, so that he thinks he can buy those securities at lower prices in future, right? So he is having a pessimistic approach. Now, blue chip. What is a blue chip? See, it is a term given to equity shares whose purchase is extremely safe. It is a safe investment. It does not involve any risk. See, buying and selling of Ambani's share is not equal to buying and selling of some company which is under a dangerous situation, right? It may collapse at any time. If you're going to buy the share, that is not safe. But if you're going to buy the Ambani share, obviously it is a safer one, right? So those kind of shares are called as blue chip shares. Okay. See, blue chip stocks are those of large, well-established and financially sound company that operated for many years. Okay. Now coming to other term, penny stocks. What is this penny stocks? See, penny stocks are the shares of the companies normally which is quoted below its par value. What is a par value? Par value means it is quoted below its original value, because it is not having a strong fundamental, in the sense it is a sick company, it is a loss company. Okay. So the market prices for the penny stocks are generally low and they have a greater degree of price fluctuations. In the sense what? It is a sick company. Sometimes if there is a demand for those company products, the price may increase. The price of the particular security may be increased. Sometimes if the demand comes very low, the price may also go low, right? So there is a high price fluctuation. Okay. Now there is something called hard underwriting and soft underwriting. See, hard underwriting means, see, there is a person called underwriter. Who is this underwriter? This is an intermediary. I told you when talking with about SEBI, their SEBI work is to control the intermediary, which includes underwriter, right? So hard underwriting is an underwriter agrees to buy his commitment before the issue is open. What does it mean? Say for example, underwriter, I told you it is a person who says to the company that I will sell these shares for you, right? So if the company is planning to sell 100 shares, okay, this underwriter, what he will do is, he will agree, he will give a commitment that I will sell all these 100 shares, okay. After the issue of share is open, this I am talking about before the issue is open, okay. After the issue of share is open, if only 80 shares are sold, the remaining 20 shares has to be taken by the underwriter, or somehow the underwriter have to sell those 20 shares. So the risk involved for the underwriter is high in the case of hard underwriting. So the exactly opposite of this is soft underwriting. What is this? See, the underwriter agrees to buy the shares at the stage after the issue is closed. In the sense what? See, after the issues has been open and once the issue has been closed, okay, after the shares have been sold, the remaining shares, the underwriter plans to buy it from the company, okay. This is called as soft underwriting. So the risk involved in the soft underwriting is less when compared to the hard underwriting, because even if it is 1,000 shares, this underwriter have to buy, right? So the risk involved is less. Now, the last three terms which you have to remember in the case of the capital market is, the first one is authorized capital. What is this authorized capital? See, it is the amount of the share capital fixed in the memorandum of association and the articles of the association that these amount of shares has to be sold. Say for example, if 100 shares have to be sold, that will be mentioned in MOU, okay. So our target is to sell those 100 shares, right. In the 100 shares, it is not necessary that all the 100 shares have to be issued. Say for example, in this 100 shares, only 80 shares are issued. Okay, we call this as issue capital. Okay, we call this as issue capital. This one is what? Authorized capital, which means to the maximum of 100 shares you can issue it, but not more than that. But you can do less than that as well. They are not mentioning the less than concept, but you cannot issue more than 100. So the amount of shares issued from the authorized capital is called as issue capital. So you would have issued and the persons would have subscribed. Okay, but in this 80 shares, you are issuing 80 shares. In this 80 shares, if only 50 shares, if only the persons who have bought the 50 shares have paid the money, okay, paid the money, then we call it as what? We call that as a paid up capital. So paid up capital is a part of issue capital, okay, paid up by the shareholders. It is that part invested by the promoters, right? So the money which has been given to the owner of the company, owner of the shares, we call that as paid up capital. So at the starting, it is the authorized capital. Below that is the issue capital. Below that is the paid up capital, right? This is a link which you have to remember. So with this, we end with the capital market, okay? So as I'm keep insisting you that you have to refer the newspapers for all the updates and to answer all the questions in the economy, you have to make sure that you are thorough in the current affairs. This videos alone will not help you to solve all the questions, but this video will help you to eliminate the wrong options, and at the same time, when you're referring to the current affairs, you will have a strong feeling that you are understanding the business page of the Hindu, right? This is what you need to get it from these videos, okay? Thank you.